ICAI students, let's revise CA Final AFM Chapter 6 Portfolio Management. Illustration 1. The following details are given for X and Y company stocks and the Bombay Sensex for a period of 1 year. Calculate the systematic and unsystematic risk for the company stocks. If equal amount of money is allotted for these stocks, what would be the portfolio risk? And they've given one table wherein average return they've given, then variation of the return, then beta, then correlation coefficient, then coefficient of determination. The average return is nothing but the mean return earned over a specified period, which is the normal return the stock is giving to the investors. And the variance of return measures the risk ideally. So variance is the spread, which is the risk of the stock, along with the risk of the Sensex also given. Now beta is the sensitivity of the stock towards market risk. So if let's say if market return increases by 1%, how much X stock will increase in response to market return. So how stock X is sensitive towards market, beta will give the number. Now correlation coefficient is nothing but linear relationship of two assets. Let's say if one asset increases, if the correlation is positive 1, then the other asset also will increases by 1. If the correlation coefficient is -1, then the other asset will decrease if the current asset increases. In our example, let's say if stock X and stock Y are correlated by +1, then both move linearly towards the same direction. If it is -1, so if X increases by 1, then stock Y will decrease by 1. So that is what is correlation coefficient, the linear relationship of two assets. Now coefficient of determination is nothing but how much variability in stock return is explained by market. So since a stock's variation towards the market, so the total variance will not be just because of market, it will be because of some internal factors also. So that's what is systematic risk and unsystematic risk. The variance of return will be the total risk. Out of that, how much market related variation happens. So the market related risk will be the systematic risk, and the company specific risk will be the unsystematic risk. Now the coefficient of determination also is on the same route. So out of the total variation, how much percentage the stock is variated towards the market related risk. So it is nothing but the square of correlation coefficient. In our case, X and the Sensex is correlated by 0.424. So if we square it, we'll get the coefficient determination. And since, as I told, the coefficient of determination will be the variability in stock return explained by the market, so the rest portion will not be explained by the market, which is nothing but the company specific risk. So as clearly stated, the coefficient of determination R square, that is square of coefficient of correlation, gives the percentage of the variation in the securities return that is explained by the variation of the market index return. In the X company stock return, 18% of variation is explained by the variation of the index and 82% is not explained by the index. So according to Sharpe, the variance explained by the index is the systematic risk. The unexplained variation or the residual variation is the unsystematic risk. So systematic risk can be calculated by multiplying the variance of security return multiplied by the coefficient of determination, which will be 6.3 multiplied by 0.18 in our case, so which will give us 1.134. ICAI has given other formula wherein they have taken beta square multiplied by variance of the market index, which is 2.25. So that will also give us the same thing. Since coefficient of determination is given only for X stock, so they might have taken this approach. But both approaches are, if coefficient of determination is given, then we can use this approach because it is easier and simpler. Now, whatever the total risk minus the systematic risk will give us unsystematic risk. Same case we can find for stock company Y also, stock Y also. Systematic risk, which is beta square multiplied by variance of Sensex, which in our case that is the market return, will give us systematic. Then total variance minus systematic will give us unsystematic. Now portfolio return is nothing but what is the variance for the portfolio. Since we have two stocks and it is given that if equal amount of money is allotted for stocks, what would be the portfolio risk? So equal amount signifies 50% in both the cases. So 0.5 will be the weight for stock X and 0.5 will be the weight for stock Y. And this is the formula for calculating the portfolio risk. And as we can see, the resultant portfolio risk is 3.5876, but the risk of stock X and stock Y is more. So this is because during diversification the risk will reduce. So portfolio risk will be always less than the individual risk of the stocks in the portfolio, because the unsystematic risk of the respective stocks will get nullified. Systematic risk can't be negated as it is same for all the stocks because it is a market related risk, but unsystematic risk is company specific risk. So if we invest in a diversified portfolio, then the unsystematic risk can be reduced. Thus the portfolio risk will always be less than the individual stock risk. Thank you.